possibly the gravest threat to the world economy since the 2008 global financial crisis. That's according to the OECD, as the coronavirus epidemic slams all sectors of the economy, from manufacturing and supply chains to universities and even film productions. COVID-19 is affecting businesses and daily lives, especially in countries where the coronavirus has hit the hardest. That's South Korea, China and Italy, just to name a few. So how should the world respond? We connect with Dr. Joon-seok, business professor at Sookmyung University here in Seoul, Dr. Ramon Pacheco-Pardo, reader of international relations at King's College London, and Dr. Graham Ong-Webb, who joins us from Singapore's Nanyang University. Thank you for joining us. Now,
thank you.
If the COVID-19 crisis continues, the IMF says the world's GDP growth could drop by 0.5 percentage points from its earlier estimate for this year. The OECD is even more pessimistic, saying that global growth could dip as low as 1.5%. That's half the 3% growth it projected in November of last year. So first of all, Dr. Oh, let's start with you. China's lockdown and its curbs on the movement of people and resources are a big setback to the global value chain. Which countries and sectors do you think should be the most concerned?
It is found that China, South Korea and Japan anchors in the whirlwind of COVID-19. Especially China has its status as factory of the world and bellwether of global GDP growth. World economy might be plummet due to the fall of global value chain. When COVID-19 cannot be controlled in short time, a failure of industry ecology system will be widened to ASEAN countries such as Indonesia, Malaysia, and Thailand malfunctioning global manufacturing network. As time goes, COVID-19 comes to block investment, employment, and economic growth, corking up the economy regardless of sectors of business, from international trade and investment to such a service trade as education, tourism, aviation, healthcare, transportation, even logistics.
I see. So a lot of sectors being hit there. Of course, those involving movements around the world, obviously. And what about you, Dr. Pacheco-Pardo? The EU is expected to be the hardest hit in terms of trade. As you can, as we're just going to see on the screen here, it's expected to lose out on over $15.6 billion in trade, according to estimates released on Wednesday. Which regions do you think should be the most worried about this protracted economic slowdown if it happens?
Well, we have seen that Italy and Spain are already suffering because tourism is down. We have seen how in the UK, Flyvia, a low-cost airline, has basically gone bankrupt. And this has been as a result of the virus. There are other airlines such as BA, Iberia, for example, in Spain. They have also announced that losses are going to be coming up in the next quarter. So I think all these sectors related to tourism are already suffering. We have also seen how universities across the European Union have started to discuss the possibility of basically canceling classes. This has already started to happen in Italy. So this sector is suffering already, and it could suffer in September when new academic year starts. And trade. Trade is going to suffer because we see less movement of goods, less movement of people between Europe and East Asia. And this has already hit several European economies, for example, Germany.
I see. Well, in order to prevent such a big fallout, central banks and governments have been rolling out emergency measures to try and reassure businesses and also stabilize financial markets. And it looks like global stocks rallied after the Federal Reserve cut its benchmark interest rate by 0.5 percentage point in efforts to support the economy in the face of the COVID-19. But is that enough to cushion the fallout? What do you think, Dr. Ong-Webb?
Well, it remains to be seen what the impact will be. I mean, clearly the move to flood the market with more cheap money, if you like, lower interest rate loans and capital is meant to encourage consumers and even investors to get out there and go out and grow the economy through economic participation. But of course, this imperative comes at odds with the other set of imperatives relating to health measures in terms of minimizing contact and the movement of people. And this is anathema clearly to economic participation, where people have to go to shops, restaurants, and patronize from service providers and so forth. And so there's a tension of sorts going on, which often comes at odds with each other.
I see. Well, the Fed is expected to have another meeting coming up soon, the US Federal Reserve, and they'll be having a televised conference, a teleconference, kind of like us right now, I suppose, in fears of the coronavirus even then. Well, the idea of a rate cut is to get people and businesses spending and borrowing money so that cash keeps circulating. But that does go against the instructions that we've been hearing from the government to prepare for the coronavirus spread. More and more people are more and more places are restricting travel, and a lot of people are working from home, not leaving the house. So do you think that the rate cut can actually stimulate spending, Dr.
Oh? It is very hard to answer, but at least theoretically, I thought it would work for a while. Limited in domestic economy. To make it simple, let's imagine there is a gas station and price board, and it shows that the price of fuel, that might be similar. The price of fuel in a gas station is an interest rate in an economy. While you drive a car, you have to see the signboard and found that the price decreased by far, then what will you do? Fill up to the max. When interest rate decrease, financing for investment becomes easier, hurdle rate becomes lower than ever before. Money comes into the market, expand the volume of trade, invest more, hire more, igniting virtuous cycle of business start to work. It is, however, true that without profitable investment project, this cycle will slow down and comes to a halt eventually. It depends on the market players creating value project. Without this kind of market players participation, this interest cut might be come to halt within a short time.
Right, and it's obviously very important for governments and central banks to take control of this situation as much as possible to prevent a widespread fallout. But of course, a lot of people are saying that what we really need is a vaccine. But health experts say that it could really take up to 3 years to produce an effective vaccine. But in the meantime, we could see more waves of COVID-19. Then how should governments and central bank authorities safeguard their economies and keep their businesses rolling? Dr. Ong-Webb, why don't you tell us what you think?
Well, there's only so much that governments and central banks and financial institutions can do. I mean, clearly we've entered a phase of this new normal where social behaviors have to adjust so that we minimize or mitigate the risks of infection, and that is going to reshape the way in which we do business, the way in which consumers and producers interact. We'll probably see a stronger dependence on online spaces and e-commerce to conduct transactions. So people will have to get used to that, especially within older segments of the market where people are not familiar with online shopping. They will have to get used to it. And I think we will adjust because at the end of the day, we all need a range of services, goods, commodities to subsist, to thrive, and we have to find workarounds. And I think that will happen over the next few years. It is already happening in some countries. Clearly, some of us, many of us here in the Asia Pacific, are feeling the hit because supply chains are being affected, and even the efficiency of business is being impeded because even if you were to buy something online, it's going to take you a few more days, possibly even a week extra to get those goods and produce. And so these are things that we have to adjust as we go along before a vaccine is found.
Right, I see. And well, Dr. Pacheco-Pardo, what kind of adjustments do you think are needed, especially in the EU, where countries like Italy or even Germany are seeing the number of confirmed cases soaring?
Well, as Professor Ong-Webb was saying, there is a lot of discussion here in Europe about boosting e-commerce, also shopping through mobile phones, but of course that's easier said than done, and this is not going to happen overnight, so this is probably going to come a little bit too late to deal with the current bout of the coronavirus. there is discussion here as to what extent we should be panicking, right? Because we have seen that the mortality rate in South Korea is quite low. In Italy, it's a bit higher than in South Korea, but it's also not very high. So there's this discussion about whether we are panicking too soon because we don't know what the actual effects of the virus are on people, right? Now, there is discussion, though, at the European level, also of trying to coordinate answers to the virus across all EU member states. But again, this is going to be probably a little bit too late for the current bout of the virus. So if it returns next year, we're probably going to see more coordination across the European Union, and we're probably going to see people relying more on online shopping than they're currently doing. This is not really happening to the extent that it might be happening in Singapore, for example, or in South Korea.
Right, and just before we wrap up, finally, what about you, Dr. Oh? What should South Korea do to safeguard its economy?
Korean government, they try their very best to boost up the aggregate demand in the market. South Korea announced a $9.9 billion worth of stimulus package to cushion the impact of COVID-19 outbreak as effort to contain the disease worsen, supply disruption, and self-consumption. This is the biggest budget stimulus the country has ever drawn in response to a disease shock. And BOK, Central Bank of Korea, also jumps right in adjusting monetary policy. Bank of Korea kept its reference rate unchanged at 1.25% at the February meeting. I suppose, however, now things has changed and reaction needed to follow a fast decision of interest rate cut by big step, 50 basis point. So to dichotomize foreign exchange fluctuations from real economic shock grounded in COVID-19 outbreak, Bank of Korea is expected to decrease the reference rate at least by 25 basis point at April meeting.
Wow, that's quite a substantial drop there, isn't it? Wow, I'm afraid that's where we'll have to end the discussion today. That was Dr. Oh from Sookmyung Women's University in Seoul, Dr. Pacheco-Pardo from King's College London, and Dr. Ong-Webb of Nanyang University. Thank you again very much for joining us.
Thank you.
Thank you.
Well, that's where we'll also wrap up our programme today. Thank you for joining us. To all our viewers around the world, we'll be back at the same time on Monday with more expert analysis on issues making headlines. Have a lovely weekend wherever you are. Bye-bye.